Welcome back, everybody. It's Stephen Young here, your investor coach. So this week, I want to talk to you about what's new in the news. Some of it's new news, some of it's old news, but specifically, we're talking about what's going on with price corrections in condominiums and pre-construction specifically. And we're also talking about HST applications. We just came up this week with one of my clients. We got a very big surprise bill. So we're talking about that today in this week's episode. Now, that being said, if you have any questions, feel free to answer them here. You can email us and we'll answer those questions every single week. Now, that being said, we have this article that just came out this week about the banks appraising properties under what somebody has paid for them several years ago. And this is not new news. This is what I was talking about earlier. So this happened back in 2008. It's a very similar crisis what happened where banks were appraising things that under what you had paid for them. So for example, let's say you purchased a property for $600,000 5 years ago. And now the builder went through the process of construction and building, and now the building is ready to go. And you're now taking possession of that property and you're going to the bank and saying, hey, bank, I put down my 20% interest as my deposit. I want 80% of a mortgage on the property so that I can now close on the property with the builder. And the bank is saying, we can do that, but we're going to appraise the property instead of 600, they're appraising it 550, let's say, in this example. And the purchaser goes to the bank and say, hey, that's not fair. I paid 600 for it. The bank says, too bad. This is what the current value is. And that's what happens in these markets that go up and down. Now, we've had the luxury in Toronto of having the markets continue to rise consistently over the past 15 years. But we are in a very strange marketplace in terms of financing, interest rates, approvals aren't what they used to be. Banks being very tight on who they're lending to and making sure the criteria is strict. And their appraisal and their valuation of those properties is not what the builders thought it was, and certainly not what the purchasers thought it was. So you got to be super careful with this. So what do? You don't have a lot of options, especially when it comes to pre-construction condominiums. So the builders' contracts are heavily in favor of the builders. So it's not like you just back out of the deal because they can charge you penalties. They can charge you carrying costs. There's a lot of things they can do that are not great, that are built into the contract that most people don't know about until it's too late. You can still close on the property with the bank and with the lower valuation. The only difference is you would have to come up with that difference. So in this example, if you purchase something for $600,000 and the bank only appraises it at $550,000, they're going to give you 80% of $550,000, and then you have to come up with that difference of $50,000. That's shortfall. That's happened to me several times actually in my career, not because of the markets, just because what I purchased for and what the banks appraised the properties for were two different things. Ultimately, I ended up being right because I'm quite sound on my due diligence when I go into these investment properties that I do. The bank didn't see it the same way I did, so I had to come up with more money on closing, which is not uncommon, but it's a surprise that most people do not plan for. So you make sure you're aware of that it can happen, and make sure you're working with a good mortgage broker who can work on the fly. So if, for example, this scenario happens and you can't get a bank mortgage, maybe you go into private money temporarily until the bank comes back around and sees that the valuations are holding still. Now, that's the market we're currently in. And this is the news article that just came out this week. I'll put the links to these articles below so you can read them. So, condos nearing completion with mortgage appraisals less than investors paid. Again, that's a combination of several factors. One, the market. Market's soft right now. It's slightly down in terms of pricing. We're down about 8% from last year. But if you look at 5 years ago, we're technically up. It's just what's happening is the banks aren't appraising them the way they were because the interest rates are so high. So they're saying your borrowing capacity or your borrowing affordability, your index is saying based on a spike of 4.5% or 5% interest rate where you're being approved for, you can now only afford a lower amount on the mortgage. So there's several factors that come into play here. Some are in your control, some are not. This one just happens to not be in your control. So don't get discouraged. There are solutions out there. If you are in that situation, reach out to us. We'll point you in the direction where you need to go and how you can get there so that you don't lose the property. Ultimately, you want to keep the property long term. It's just a difficult thing to close, and then you're short on, or the bank's saying it's not worth what you paid for it. It's common, but it's not as well known, just because we've had such a run up in the marketplace. So that's that point. Next article I want to talk to you about is tax implications. Really, what is the important thing in this topic today? Because this just came up with a client and they're in a difficult situation. But when you're buying pre-construction condominiums, you don't have the ability to just sell it and flip it. So years ago, when I first started in real estate, about 18 years ago, these laws weren't in place. So a lot of people were buying pre-construction condos and flipping them and then walking away with a big bag of cash, basically. And they weren't paying capital gains tax. They weren't paying HST. And they ruined it for everybody, because when the CRA figured out what they were doing, they cracked down. They cracked down on the buyers and the investors. They cracked down on the builders. And they basically passed laws to state that if any disposition of any property, especially new, comes about, the lawyers have to disclose the information. The builders, the buyers, and the sellers, they all have to disclose that information. And if they don't, there's massive tax implications. We're talking like hundreds of thousands of dollars of tax implications. So it can be extremely litigious, and it can be extremely costly if you don't know what you're doing. That being said, it was probably about just after the 2008 financial crisis, we had the first capital gains came in with the assignment tax. That was the law that was passed about in 2009, I think it was. And then about 3 years ago, there was another law passed about the HST. Whereby that you can actually now be taxed not only on the assignment, but you're now taxed as business income, irregardless of the property, if you want to live in it or not. Let me give you some examples. So let's say in the scenario I used earlier that you bought a property for $600,000 and the bank says, look, it's only worth $550,000. So someone says, look, I can't afford an extra $50,000 to come up with, so I'm just going to sell the property and dispose of the property. And you go to the market, and let's say you sell it, and you sell it for what you paid for. Let's say it's $600,000. So because you sold a new property, the government is saying you now owe us HST on the sale of that property, because you're selling a new property, unoccupied or occupied. And then you also owe us capital gains tax, but the capital gains tax is to be deemed business income. So you're being charged on the entire gain. It's a lower amount, but it's ultimately paying more for it. So you have this double taxation on top of land transfer tax, on top of commissions to pay. Like, it's going to cost you so much money to sell it that it's never worth it to sell it. So if you're in that situation where you can't afford it or you didn't have the deposit, just reach out to us. We'll show you what to do and how to do it. Essentially, you can get joint venture partners, you can get private financing, you can get short-term bridge financing, you can get collateral mortgages. We have so many different ways to help you out. So don't think you have to sell it. It's probably the worst thing you could do. Case in point, this article talks about, I'm going to have these links for you down in the description. So when you get down to it, it talks about, so there are times where you won't have to pay HST. So let's say you've lived in your house for 20 years or 30 years. It's an older property and you sell it. You don't have to pay HST and you don't have to pay capital gains tax, not in Canada at least, but they're trying to change that, but it won't be happening anytime soon. So you don't have to pay a business disposition. There's nothing you have to pay. Now, if you buy something pre-construction or new, or you get into a situation where you want to renovate your house and the renovation is substantial, and then for whatever reason you wanted to sell it, you will have to pay HST on that sale. A lot of people don't know this. And unfortunately, the sale goes through. The agents don't know it. They're not being teaching their clients properly. And lo and behold, your client's left with a massive bill, usually in hundreds of thousands of dollars, especially in the city of Toronto, because the cost, it's based on a percentage of what you sell it for. So you're literally being charged hundreds of thousands of dollars. So it's never worth it to do. So home flippers, pre-construction, land, all these things. Again, I'm going to have these links for you in the description. But if you're selling land, if you're selling a sale of unoccupied new or substantially renovated house, so that's house flippers. It's unoccupied new, meaning you bought pre-construction, you had it unoccupied, and you sell it. Or even if you had it rented, just down below, there's another one there, sale of real property made in the course of individual business. meaning that if you are buying something to rent out and then you say, like, I changed my mind, I just want to sell it, you are also deemed to be trading and you're charged HST. So you got to be very careful. And HST in Ontario is 13% of the sale price. So if you're selling something for $1 million, you're paying $130,000 of this HST just to sell the property that's deemed under these new regulations under the CRA. So when it comes to exemptions, the only exemption is if you lived in the property for many, many years and it's not new. There's some other exemptions when it comes down to divorces and deaths and stuff of that nature. And again, it's all in this article you can read. This is from the CRA, so it's not from me. It's not from some random person or accountant trying to interpret this thing. This is the code. This is the actual tax code of Canada that you can read through and walk through and say, look, am I going to be deemed HST or not? If you don't want to spend the time with it or the research, which I highly recommend you do, reach out to me. Again, we are well versed in this. We've been doing it for 18 years. We've helped navigate hundreds of clients around this. All good. It's all above par. It's all according to the tax laws. We just ultimately what has to happen, you have to just hold the property, period. Especially if it's a pre-construction condo. So earlier I talked about back in 2008 and 2005, like a lot of people are flipping these condos and they're just walking away with like massive gains. They were buying properties for, $500,000, selling them for $600,000 within a month or two, making $100,000 and never reporting the money. Didn't have to pay HST, any of that. So you got to be, so that ruined it for everybody because that was awful and they didn't report the taxation. So when the CRA got involved, they just said, look, we want to make sure that we're not picking on real estate. It's just they treated real estate as though it was a business or you were selling a fridge or a car or whatever. All those other asset classes have the same taxation. Just people in real estate think for some reason I don't have to pay HST because it's for some reason you don't have to pay HST normally in a resale property. And I think that's where a lot of people get confused by it because it is an odd tax to pay, and especially on you're paying 13% tax on a fridge. You're looking at like maybe $100 or something, but on a piece of real estate, you're talking hundreds of thousands of dollars. So it's a shock to a lot of people, but it is an actual law and regulation. And when it comes down to assignment sales, this is where it gets really hairy for a lot of people. So in the situation I gave earlier where someone purchased something for $600,000, and let's say the market is actually up in this case. Let's say the value of the property has gone way up and it's now $700,000 property. And you say, look, I still can't afford to keep it or close it, or I went through a divorce, or my life changed, or it's too small, or it's too big, or whatever is going on. And you say, hey, you call some random agent and you say, sell my property for me, just dispose of the property, and we'll go from there. And then the agent does that, doesn't tell you about this tax implication, generally because they don't know about it. And then they sell, and then a few months later, you're going to get a bill from the government for 13% of $700,000 for your HST for disposing of the property, even though it was an assignment. You just traded the paper. You never actually took possession of the real estate. That under this law is also HST applicable. And most people don't know that, unfortunately. And they end up paying that massive bill way down the road. And it usually comes out of their pocket because most of the proceeds either paid through you got legal fees, you got commission fees, sometimes marketing fees, but for the most part, the HST takes out all your profit from an assignment sale. So it's generally not worth it to do that. Now, that being said, I was in a situation a couple of years ago with one of my clients who had purchased a property from someone. So the seller, it was an assignment sale, and I told him all of this up front. The assignment sale, the seller, the assignor, had to pay HST to the government. And because my purchaser bought it, and then he's going through a difficult situation, had to sell it within the year time that you could dispose of the property, he also had to pay HST. So the government collected capital gains tax from the original seller, HST from the original seller, HST from the secondary purchaser, so it was my client, and then they collected HST from me on my commissions and all sorts of stuff. So the government raked in hundreds of thousands of dollars just because there was a situation where someone had to dispose of a property, and then just because of life situations, there was another disposition within a certain time frame, and they deemed it to be business trading, which it wasn't. But that's just how the courts awarded that deal. So unfortunately, it happens. We did our absolute best to sort of help that client out, but they're in a bad situation, and got worse, unfortunately. But that's it. That's the reality of real estate, unfortunately. Now, so what happens is, the flipping rule 2, I just want to real quick talk about. These are the only exemptions when it comes to non-taxation of flipping. You can go through them yourself, but quickly it's like death, or you're doing an addition. You sold something just because there was an addition. So let's say you bought a 1-bedroom condo and it took 5 years to get ready. And then within that time frame, you had like your mother had to move in with you, and you had 3 kids before the time the condo was ready. And the 500 square foot 1-bedroom condo won't support 6 people. So that's an exemption, but you'll have to get through your special permission. Separations, personal safety, disability. So you actually, or something happened to you, employment changes. That one's a tricky one. A lot of people try and use that one. New locations, job relocations. They're a very famous story a few years ago in the papers. The press covered it, of a woman from Africa who's trying to get her, law degree here in Toronto, purchased the property while in university. By the time she was graduated, 3 or 4 years later, the condo was ready to take possession, but she couldn't get a job and she couldn't get permanent status. And so she had to leave the country back to her homeland. And then what happened was she disposed of the property, and the government deemed her that she was trading in real estate. So she had to pay HST, and she had to pay the business taxation on it. And it was like hundreds of thousands of dollars on the property. And it was huge news because a lot of people didn't understand it. They didn't really know how they could sort of avoid it or get around it. But you can't. That's unfortunately how, no matter what the situation was, that one didn't work out for her, unfortunately. So what happens is this leads to some questionable tactics. This is an older article, but this, unfortunately, when you have such heavy-handed taxation, sadly, people try and avoid it to a point of they take questionable actions. And again, I'll leave this link down below the video. But what happened in BC years ago, people started doing some difficult, some questionable tactics, selling things to quote unquote family members, saying they lived in properties, but they didn't live in properties, saying they were local residents when they weren't local residents, never claiming to own the property. We call these phantom mortgages, where they just pass on everything, walk away from the deal. They just get their money back that they put into it. They're doing some really shady stuff. That being said, the government caught up to it and then started chasing these people. And you can read through the article, but essentially people are being charged, this one here, $125,000 tax. There's another one down in the article with $300,000 in terms of penalties because they were trying to avoid the tax illegally. This one here, the GST they had to pay was $344,000 to a developer who tried to avoid it, couldn't do it. So, it's not great news, but it's news that you need to hear. It's news that's relevant, especially you want to be investing. You need to know the rules and how to play by them. This is why I'm so heavy on the resale market, just because all this taxation doesn't apply to all that market. And you can certainly make the same, if not more money in the resale market. You don't have to wait for things. So there's some pros and cons to pre-construction condos. I understand why a lot of people buy them. But if you're going to buy them, make sure you're aware of what you're doing and make sure that, you go into these with your eyes wide open, because you don't want to get to a situation where you have great ideas and great intentions of buying something to improve your life, change your life, build wealth for you and your family. And then you get into something that you don't understand how to get out of, or to avoid, or to just make as part of your plan. And what happens is you get stuck with a huge bill. And I don't want that happening to you. So make sure you follow us. If you have any questions, please leave them down. We'll answer them every week, and we'll go from there. All the best.